Did you hear the IRS just confirmed a whopping $4,750 deduction for seniors? Sounds like a huge win, right? But here's the catch. There's a new Medicare rule that could actually cost seniors an extra $300 every month. What's really going on, and how will this affect your retirement income? If you're over 65 or caring for an elderly loved one, you absolutely need to know about this. While the IRS is offering big deductions that seem like a financial boost, the changes to Medicare premiums might quietly eat up those benefits, leaving many seniors worse off than before. So, how exactly is the IRS adjusting these deductions, and what hidden costs does the new Medicare rule bring? In this video, we'll break down these complex policy changes in simple terms, so you can understand what's at stake and protect your hard-earned money. Don't let confusing rules drain your savings. Knowledge is power, and it's time to take control. Click play now and get the facts you need to make smart financial decisions for yourself and your family. If you find this video helpful, make sure to hit that like button and help us keep bringing you vital tax and financial updates tailored just for you. You might be thinking, $47,500 deduction? That sounds incredible. Is this finally the tax break seniors have been waiting for? And on the surface, yes, it certainly seems like a fantastic opportunity to reduce your taxable income and potentially increase your refund. But as with many things in the world of taxes, there's more beneath the surface, especially when Medicare comes into play. That extra $300 monthly cost tied to Medicare premiums might just wipe out the benefits you're expecting from this deduction. So what's really happening here, and how can seniors prepare for these changes in 2026? Let's start by breaking down the IRS's announcement. For the first time in years, the deduction amount for seniors, the standard deduction for taxpayers aged 65 and older, has been significantly increased to $47,500. This is a notable jump, designed to help seniors keep more of their hard-earned money and ease their tax burden. The idea is to recognize the unique expenses and challenges that come with aging, from healthcare costs to living expenses that often rise unexpectedly. However, this new deduction doesn't exist in a vacuum. Medicare, the federal health insurance program primarily for people aged 65 and older, is undergoing its own set of changes. Specifically, the premiums that many seniors pay monthly are rising, and for some, that increase could be as high as $300 every single month. When you factor in this Medicare premium hike alongside your tax deduction, the financial picture isn't as rosy as it might seem at first glance. Why are Medicare premiums rising? It's a combination of factors: rising healthcare costs nationwide, changes in federal funding, and adjustments made by the Centers for Medicare and Medicaid Services to better align premiums with healthcare expenses. This means that while the IRS is trying to help seniors with tax deductions, the cost of their essential healthcare coverage is simultaneously going up. So, what does this mean for the average senior? If you rely on Medicare Part B or Part D, you could see a significant increase in your monthly expenses. For some, an extra $300 a month adds up to $3,600 a year, money that can seriously impact your budget, especially if you're living on a fixed income like Social Security or a pension. One critical point that seniors need to understand is that the IRS deduction and Medicare premiums are two sides of the same coin but managed by entirely different agencies with different priorities. The IRS focuses on tax relief, while Medicare focuses on covering healthcare costs efficiently and sustainably. Because these systems don't coordinate their policies, you might find yourself caught in the middle, wondering why a big tax break doesn't fully offset rising healthcare expenses. Now, let's talk about how you can prepare and what steps to take to navigate this complex financial landscape. First, it's essential to get a clear understanding of your current Medicare coverage and premiums. Medicare isn't just one program. It includes different parts like Part A, hospital insurance, Part B, medical insurance, Part C, Medicare Advantage, and Part D, prescription drug coverage. Most premium increases are related to Part B and Part D. Make sure you review your Medicare statements carefully, especially any notices about premium changes. Knowing exactly what you're paying now and what you'll pay next year gives you the foundation to plan effectively. Next, consider your income level because Medicare premiums are income-related. High-income beneficiaries pay more for Part B and Part D through what's called income-related monthly adjustment amounts, or IRMAA. If your income has gone up in recent years, or if your tax filing status has changed, you might find yourself paying higher premiums than before. This is especially important because these premiums are deducted from your Social Security benefits, so they directly reduce the money you receive each month. Here's where the $47,500 IRS deduction comes into play. This increased deduction could lower your taxable income on paper, but it won't affect the income figure Medicare uses to calculate your premiums. Medicare bases premiums on your modified adjusted gross income from 2 years prior. So if you expect to lower your taxable income this year with the deduction, it might not immediately translate to lower Medicare premiums in 2026 or 2027. This timing mismatch can be frustrating and confusing. Given these circumstances, seniors need to plan their finances with a long-term perspective. One strategy is to estimate your modified adjusted gross income well in advance and consider ways to manage it. This might include timing distributions from retirement accounts, managing investment income, or even exploring qualified charitable distributions if you're over 71 too. These financial moves can help reduce the income Medicare uses to set your premiums. Additionally, don't overlook the importance of filing your taxes accurately and on time. The IRS deduction can be a powerful tool to reduce your tax liability, but only if you claim it correctly. Many seniors miss out on deductions because they don't fully understand the paperwork or the eligibility criteria. Working with a tax professional who understands both tax law and the intricacies of Medicare can save you hundreds or even thousands of dollars. Let's not forget the role of Social Security benefits in this mix. Many seniors depend heavily on their monthly Social Security checks for living expenses. The rise in Medicare premiums means those checks could be effectively reduced by that $300 monthly increase. That's why budgeting becomes critical. Knowing exactly how much you'll have after premiums and taxes allows you to plan your spending better and avoid surprises. On a broader scale, these financial pressures highlight a larger challenge facing many seniors today: balancing healthcare costs with fixed incomes. Healthcare expenses have been rising faster than inflation for years, and while programs like Medicare provide essential support, premium increases are a reality many must face. The IRS's increased deduction is a step toward offsetting some of these costs, but it's not a complete solution. For many, it may be time to explore additional insurance options, such as Medicare supplement plans, Medigap, or Medicare Advantage plans, which can sometimes offer more predictable costs. Each option has pros and cons, and what's best for one senior may not be best for another. Researching these plans thoroughly or consulting with a Medicare advisor can help you make informed choices that fit your health needs and budget. Furthermore, staying informed is vital. Policies around Medicare and taxes can change annually. The $47,500 deduction and the Medicare premium increases are just the headline changes for 2026. Future years may bring more adjustments. Keeping up to date with official announcements from the IRS and Medicare will ensure you don't miss important deadlines or opportunities. Another key consideration is understanding how your state's programs interact with federal policies. Some states offer additional assistance to low-income seniors to help cover Medicare premiums or medical expenses. If you qualify for Medicaid or other state aid programs, these might help reduce your overall healthcare costs significantly. It's worth checking with your local social services or aging department to see what support is available. Now, you might wonder if there are any quick fixes or shortcuts. Unfortunately, there's no magic bullet when it comes to balancing taxes, Medicare, and retirement finances. It requires careful planning, awareness, and sometimes tough choices about spending and income management. But with the right knowledge and support, you can navigate these challenges effectively. Let's look at a hypothetical example to illustrate how these changes can impact a senior's finances. Imagine Mary, a 68-year-old retiree who receives $3,000 a month in Social Security benefits and has additional income from a small pension and savings withdrawals. Thanks to the new IRS deduction, Mary's taxable income decreases, and her tax bill is lower than previous years. However, her Medicare Part B premiums increase by $300 a month due to the new rule. When she subtracts that from her Social Security, her net income decreases noticeably. Mary decides to meet with a financial advisor and a tax professional who help her adjust her withdrawal strategy from savings accounts, manage her investments to reduce taxable income, and explore Medicare Advantage plans that might offer lower premiums. She also applies for state assistance programs. While it requires effort and some lifestyle adjustments, Mary ends up with a more manageable monthly budget and peace of mind heading into future tax years. This example underscores the importance of proactive financial management. Don't wait until the last minute or until you face a shortfall to take action. The sooner you understand the new IRS and Medicare rules, the better equipped you'll be to protect your finances. If you're caring for an elderly loved one, it's equally important to support them through these changes. Many seniors feel overwhelmed by tax paperwork and healthcare decisions. Helping them stay organized, seek professional advice, and understand these new rules can make a world of difference. In addition to professional help, there are plenty of resources online from the IRS, Medicare.gov, and nonprofit organizations dedicated to senior financial health. These resources often provide free guides, webinars, and hotlines you can call for personalized assistance. To wrap up this section, remember that while the $47,500 IRS deduction for seniors sounds like great news, it's just one piece of a much larger financial puzzle. The rising Medicare premiums are a significant factor that can offset those savings if you're not careful. Understanding both sides and planning accordingly is the key to maintaining financial stability in your retirement years. We'll continue to dive deeper into strategies and tips throughout this video, so stay tuned to get all the details you need. Making sense of these complex changes can feel daunting, but with the right information, you can turn uncertainty into confidence and take control of your financial future. Now, let's explore some practical steps seniors can take to make the most of the $47,500 deduction while managing the rising Medicare costs. One of the first things to consider is your overall tax strategy for the year. Since the deduction reduces your taxable income, it can potentially lower your tax bracket, which means you might pay less tax on some of your income. But to really benefit, you want to maximize deductions and credits beyond just the standard one. For instance, if you have significant medical expenses, including premiums, doctor visits, prescriptions, or even home health care, these may qualify for itemized deductions if they exceed a certain percentage of your adjusted gross income. Keep detailed records of all medical expenses because every dollar can count toward lowering your tax bill. Another area to look at is charitable giving. Seniors who itemize deductions can benefit from charitable contributions. Plus, if you're over 71-2, you can make qualified charitable distributions, QCDs, directly from your IRA, which lowers your taxable income without counting as a taxable distribution. This strategy can help reduce the income figure Medicare uses to calculate your premiums, providing a double benefit. It's also a good idea to review your investment income. Capital gains, dividends, and interest all contribute to your taxable income. Sometimes strategically timing sales of investments or offsetting gains with losses can reduce your overall tax liability. This kind of tax planning might require some guidance from a financial planner who understands seniors' unique needs. Next, let's talk about Medicare plans and how seniors can shop smart to manage rising costs. Medicare Advantage plans have become increasingly popular because they often bundle hospital, medical, and prescription drug coverage with additional benefits like vision and dental, sometimes at a lower overall cost. But they're not right for everyone. Carefully compare the out-of-pocket maximums, premiums, and coverage details. If you stick with original Medicare, consider Medigap policies. These supplemental plans help cover deductibles, coinsurance, and copayments that original Medicare doesn't cover. The monthly premium you pay for Medigap can add to your expenses but can also protect you from potentially huge medical bills. Another tip is to look into assistance programs. Many states have programs specifically designed to help seniors pay for Medicare premiums and medical costs. Some pharmaceutical companies offer prescription assistance programs, and nonprofit organizations can connect you with local resources. Don't hesitate to ask for help. There are more options available than most people realize. When it comes to budgeting, adjusting for that $300 monthly increase in Medicare premiums means reviewing all your fixed and variable expenses. Are there subscriptions or services you no longer need? Could you switch to a more affordable phone or internet plan? Small savings can add up over time, easing the pressure on your budget. And don't forget about the power of community. Many senior centers and local organizations offer workshops on tax preparation and Medicare planning. Attending these can help you stay informed, meet others in similar situations, and even discover new resources. Now let's touch on some common misconceptions that seniors might have about this $47,500 deduction and Medicare costs. One is the idea that this deduction automatically means more money in your pocket every year. While it can help reduce your tax bill, it doesn't guarantee a refund or offset all expenses. Taxes are complex, and many factors affect the final numbers. Another misunderstanding is thinking Medicare premiums are static. They can and do change annually based on healthcare costs and government policies. So, what's true this year might be different next year. It's important to review your Medicare summary notice and any communications from the Social Security Administration each fall to stay updated. Some seniors believe that if their income is low enough, these changes won't affect them. While it's true that income levels influence Medicare premiums and taxes, even moderate income increases can push you into higher premium brackets. So it's always wise to review your situation annually. There's also confusion about the timing of income calculations. Remember, Medicare premiums are based on your income from 2 years prior, so planning now can influence premiums down the road, but not immediately. As we continue to face rising healthcare costs and evolving tax rules, staying proactive is the best defense. The IRS's increased deduction for seniors is a helpful tool, but it's only one part of a bigger financial puzzle. By understanding Medicare premium changes, exploring assistance programs, and strategically planning your income and deductions, you can reduce the financial strain and enjoy a more secure retirement. Let's consider another scenario. Tom, a 70-year-old retiree who has significant medical expenses but wasn't aware of the new deduction. Without claiming it, he ended up paying more taxes than necessary, and combined with rising Medicare premiums, his disposable income shrank noticeably. After working with a tax advisor, Tom learned how to claim the deduction properly, track his medical expenses, and adjust his Medicare plan to a more cost-effective option. This improved his monthly cash flow and lowered stress. Stories like Tom's are common, which is why awareness and education are so important. No one should have to struggle silently or miss out on benefits due to lack of information. As we move forward, keep in mind that every senior's situation is unique. Variables like your health needs, income sources, state of residence, and family circumstances all play a role in how these tax and Medicare changes affect you. Taking time to analyze your own circumstances, perhaps with professional help, can make all the difference. If you're a caregiver, advocate for your loved ones by helping them gather documents, understand their statements, and ask questions to Medicare or tax professionals. Your support is invaluable. Finally, keep this conversation going. Share what you've learned with friends and family so they aren't caught off guard by these changes. Subscribe to trusted channels, attend community events, and keep an eye out for IRS and Medicare announcements. Remember, these policies might feel overwhelming, but with the right tools and knowledge, you can take control of your finances and protect your retirement years. In the end, the new $47,500 IRS deduction for seniors is a significant development that can offer much-needed tax relief, but it's crucial to understand how it fits within the bigger financial picture, especially with the rising Medicare premiums that could cost some seniors an extra $300 each month. Navigating these changes isn't always easy, but with awareness, careful planning, and the right resources, you can protect your finances and make informed decisions that work best for your unique situation. Remember, knowledge is your greatest asset in securing a stable and comfortable retirement. If this video helped you make sense of these complex changes, please give it a thumbs up and consider subscribing to the channel for more timely updates and practical tips tailored to seniors and caregivers. Stay informed, stay prepared, and we'll be here to guide you every step of the way. Thank you for watching, and take care.